Hello and welcome to Livewire's income series for 2025. My name is Chris Conway. Today I am sitting down with the Senior Portfolio Manager and Co-Managing Director of Gryphon Capital, Ashley Burtenshaw. Ashley, welcome.
Thank you, Chris. Thanks for having me.
Ash, I'm going to start big. The residential mortgage-backed securities market, or RMBS market here in Australia, $2 trillion as it currently stands, growing every year, so it's a monster. Yep. You use a data-driven approach to unpack it all. What data are you focusing on?
The way I sort of think about it, and you know, it's a view held at the IC, is data breeds certainty. And that data set has been compiled since 2010 out of the sort of the ruins that we saw in the US in terms of the global financial crisis, all the way through to today. So it's 15 and a half years that database has spanned. When you think about, you know, some of the events, you know, we've seen European bank crisis, we've seen house prices up and down, we've seen banking royal commissions, we've seen COVID, we've seen the de-sharping in 22. It's a very rich data set, and it is our edge, Chris. It is our edge, and we refer to it as our knowledge advantage. And so just to give you a flavour for the scale of it, right, is we have approximately 205,000 residential loans, and we have around about 101,000 consumer loans. And so we can capture anything up to about 30 or 40 data points on each of those loans, both the residential and consumer loans. So if you think about that, and that's dynamic, that's every month that someone's making a payment. We're dealing with, you know, 10 to 12 million data points every month. But, you know, you ask for what are the ones that we're sort of focused on. It comes down to predictability, as you hear us as well talk a lot about. And that predictability, we're seeing, you know, in terms of loan seasoning, you know, that's really important to us. Mortgage rate tells us the complete picture, who we're sort of, you know, funding. Why do you get a cheap rate when I get an expensive rate? You know, those types
Probably
of things.
Probably the other way around, but
well,
sure.
Who knows? I don't know about that. And so you think about that, and then, you know, we're also looking at, you know, loan to values, clearly, because in the world, if a borrower does default, you want to make sure that you've got sufficient security to repay to yourself. But then also, you know, that loan to value, because we're very centred on the valuation, we want to know where that resides, so what postcode, and we're mindful of being in outliers, you know, where it's sort of, you know, single industry mining towns or townships or urban areas where there's less than, you know, 10,000 people, those sort of places.
Ash, question without notice around the data. You've got this treasure trove of data, as you were just talking about. You see the good and the bad. Is there any data that you've seen over the journey that, you know, scared you or thought, geez, that looks a bit hairy?
With the data that we've actually been accumulating over 15 and a half years, a couple of things that we saw was one actually in New Zealand, where we saw a large loan balance. And what we mean by that is it's a big dollar amount of loan against the house. Right. And so when we looked at that security versus where it was located, going back to the postcodes, that actually did scare us from in terms of, wow, you could lend that amount of money in that remote postcode, therefore that scares us in terms of if the actual borrower which was going to default, what the actual loss could actually occur by being in that security. So yes, we have seen a couple of things, but really we're all about predictability and looking at loan seasoning, we're looking at mortgage rates, and we're also looking at, you know, the leverage in the transactions, be it at the borrower level.
Yeah. So just an extension of that, Ash, researching the data, like I said, having that treasure trove, when it comes to constructing the portfolio, how does it actually help you construct the portfolio at the other end?
If you think about assigning the probability of default, which is all about the ability to pay. So we like borrowers paying for a longer period of time, which we refer to as loan seasoning. The longer they pay, the better they become, right? Then what we also look for is the mortgage rate. The mortgage rate tells us a huge amounts of information about the borrower. If you think about it, why does that borrower pay a high rate versus that borrower that pays a low rate? It tells us the complete picture of who we're actually funding. And then what we've then got to look at is then assigning, if there is a problem about that ability to pay, is what's the loss given default, assigning a loss given default. And that all comes down to the LTV. And that LTV, we capture 3 data points: the original LTV, the current LTV, and the indexed LTV. And the index is moving as house prices moving up and down, but the valuation stays the same. And then ultimately, where's that security located? Which postcode? Is it in a metro? Is it in a single industry mining town? Where's it located? Because then that also tells us a story. Because within Australia, there are some postcodes that are worst performing, and they've been labelled worst performing. Also, we don't like high density, because if you get a wrong sale in terms of that, will reset all security in that sort of postcode. So there are a couple of things that we definitely are on the watch out for.
Yeah. As a mortgage holder, I don't know whether that's scary or insightful, mate.
It's insightful. Take it from me,
Insightful,
Chris.
there you go. Ash, there's been this narrative in the market for a while that higher interest rates will lead to mortgage stress, higher bad and doubtful debts, and things of that nature. It's probably a narrative that prevents some people from participating in this space. What does your data say, and what would you talk to about that narrative?
RMBS bonds have never defaulted in the history of the market, right? So call it 30 odd years. The way I'll sort of answer it is sort of citing a very famous parenting, saying. And I actually delivered this in a presentation a couple of years ago, and I said, small kids, small problems, big kids, big problems. Small loan balances, small problems with the higher interest rate, right? Yeah. Big loan balances with a big interest rate, big problems, right? And so the data zeroes in on all that information. Yeah. And so if we go back to 2024, when we had peak rates coming through, we saw within some of the sort of the higher mortgage payers, they eroded, their performance eroded a little bit. They were sort of finding it very difficult. And, but then as we're, looking at our analysis, we found that they weren't finding other money to get back to current. But what we did see through that period is house prices were steady and continued climbing. So they were actually then realising they were in unaffordable situations, and then they were working with their lender and finding the right solution. However, in the second half of 24, where when you look at the sort of, in this country, we do annual salary reviews at sort of June, you get your CPI linked salary. So when we looked at that, and obviously the tax break that followed, that was interesting enough to us that we saw that rather than they didn't have any money to get back to current, we're finding some of those borrowers were now got the extra little funds to now improve their sort of mortgage performance. And so, if you think about it, it's all in the data, Chris, ultimately. Yep. And, the way that we sort of set up when rates are going up and down is always looking at the data and the loan balances, because that's a huge driver, and obviously the leverage in the transactions.
Ash, you've recently launched BLIS, which is the Barings Liquidity Investment Strategy, in conjunction with Barings, of course. What does this new fund offer investors, and how is it different from GCI?
The way that we think about it, internally, is what we're doing there is basically a liquidity seeking strategy. Mm-hmm. So it's out there for liquidity purposes. We see the actual returns that we extract that we're overcompensated for that liquidity risk premium, because in what we do, it's not part of the sort of the traditional credit products that trade on electronic platforms. So because of there's not that same sort of visibility or transparency about the pricing, you get this, what we think, enlarged risk premium, which we believe is very valuable because we can manage that liquidity. So that's the origins of BLIS, where GCI, it's a little bit different. It actually then looks at where we're saying it's return seeking. And what we mean by return seeking is that we're overcompensated for the risk, okay? And so within that, and if you think about our universe, we traffic in both the warehouse markets, but also the public markets. It enables us to extract that e-liquidity premium that's available in that market, purely because RMBS bonds are a little bit more complex, or they're just not as simple as some of the more generic products that are out there. So that's how we sort of think about it, and we divide it: liquidity seeking versus return seeking.
Ash, your recent monthly talked about continued stabilisation in the RMBS market amid renewed investor demand and new issuance. So can you just unpack those elements for us, and what are the big trends you're seeing in your space?
So Chris, April was, it was a very interesting month, right? And the full story doesn't really come out, because if you start the month in April and end the month April, wasn't too bad, but in between it actually got a little bit hairy. Yeah. So we actually looked through into the secondary market. The secondary market tells us everything about what's the oxygen in the market. Like, are people happy to take risk? Are they happy to sort of buy risk and then sell risk? And are they take it on their own account, or they're happy to, to pass through? And what happened there for a period of a couple of days is what we call bid for appointment. So I've got this, piece of paper or this bond looking to go to sell, but the dealer actually needs to then say, well, okay, I can't really find another buyer, so I've got to actually then work through and see where I'm happy to bid it. And so it's very illiquid in that period of time. Then as we saw the tariff storm start to subside, we started to see liquidity from that secondary dealing desk starting to tighten up what we call their bid-offer spread, so where they buy and where they offer. And then once we saw that, we actually then knew that the market was in their healing process. And then if you look at sort of like secondary markets versus primary markets, a primary market deal would be $1 billion, so that's a lot of capital to put into work. So it sort of takes a bit of time, and because investors are putting in lots of money, they actually then need to be rewarded and need a little bit more certainty. And so if you're careful where you're actually hunting in the markets, especially in the primary markets, there was some nice, opportunities that were very profitable for us, and which we pounced in April in the secondary market, but also in May in the primary markets.
Yeah. Talk to me a little bit more about that, because that was the other thing I noted for the monthly, that BLIS deployed some of the cash holdings across those new issuances. So yeah, it was just a fantastic opportunity that you had to take advantage of, is sort of the read that I'm getting.
In terms of RMBS, and we're talking about that visibility and transparency in terms of the price action, where if you look at the more vanilla credits, the bank credits, that was tightening in rapidly, very, very quickly. And so because we're actually involved in the secondary market, we knew what was trading, in those in that dark moments. And so what we then basically, said at the IC is, well, that's where we want to go, because if we have another event, or as events unfold again, we know what trades, we know what gets the liquidity. So we just moved into the same part of the market, which were the AAAs and some of the AAs that were getting a lot of liquidity in those periods. So yeah, and basically the vanilla credit markets did all their heavy lifting, and then it became a nice little momentum trade into month end.
Yeah, nice. So Ash, talk to me a little bit more about relative value. So again, base understanding here, but just bear with me. You've been able to get the same or better returns without taking on greater risk, is sort of the message that I picked up again from your monthly. Is that accurate, and is that really the cornerstone of your active approach?
Well, let's break relative value down in three components, right? As we've talked about, RMBS isn't as familiar to other asset classes. So you get this sort of spread differential between a like-for-like RMBS bond versus, say, vanilla bank credit. And it's a quite sizable margin in terms of that spread differential. But then if you think about going through and saying, okay, well, once I look through, and of course I've got all this data, and I'm buying, say, a AA bank piece of paper in the market, the probability of that being upgraded in this world in terms of the banks ever getting upgraded from AA, very, very low probability. But because of our data set and all that information that we have at our fingertips about the performance of our RMBS bonds, we can actually buy AA bonds that actually have the inherent, what we call, probability of being potentially AAA. So right. Relative value to us means quite a bit more than just the spread differential, and and then clearly the other thing that we talk about internally is when you're talking about the relative value, there's other ways, there's a myriad of other ways if you're active to get that, to get that value. And that's, the steepness of credit curves, the flatness of what we call credit duration curves, all these types of things, can give you other levers to be able to extract further relative value.
Yeah. Ash, you've probably touched on some of the elements there, but there's this growing debate about the value of active management. So I just wanted to close by asking, what edge does Gryphon bring, particularly against some of those passive products?
So if you go to sort of active versus passive, it's a fantastic debate, really.
Isn't it?
It's a great debate. The way I look at it is I go the other way, is going, okay, upside markets versus downside markets. If you look at active in upside markets, it's very hard, and I'm not saying people don't beat passive in upside markets, but it's very hard to beat.
Yeah.
When
everything's flying.
And because you think about the investor on the active, they have this inherent value bias embedded in their DNA, so they're sort of probably more willing to take profit, earlier than the passive, the big moves in the passive markets. So I think, in terms of the debate, I think it really centres on the downside capture. Mm-hmm. Because if you capture 100% of the downside as an active manager, I then think you really are dead man walking. Yeah, right. So I think it's all about the downside capture, and I think we can live with a little bit of underperformance in the upside capture. But I think if you can actually outperform on the downside, I think you have a role in the markets.
Well, you're also protecting capital for investors at a time when they especially need it, right?
That's right, correct.
Yeah. Ash, I could sit here and talk to you about this stuff all day, but that's a wrap. Thank you so much for joining us and taking part in Livewire's 2025 Income Series.
Thank you, Chris.
If you enjoyed that interview, make sure to give it a like, and don't forget to check out the rest of the Income Series content available on the Livewire Markets website.